Welcome to our deep dive, into the world of finance. Um, Looks like from these sources you've sent over that you're really diving deep into bonds and banking and all the kind of systems that make the financial world tick.
Absolutely.
We've got a stack of your sources here ready to unpack some serious aha moments, I
Yeah.
think. Today, we're not just talking theory. We're going to uncover what really happens when you deposit your, hard-earned cash or invest in a bond.
Yeah.
We're even going to demystify the world of short sellers.
Yeah, those enigmatic
Yeah.
short sellers.
Yeah.
We're going to have a lot of fun, and we're going to be exploring concepts like present value, credit risk, the building blocks of financial decision making.
Yeah.
But don't worry, we'll use real world examples and connect the dots in a way that makes even the most complex ideas click.
Okay. Let's unpack this.
Mm-hmm.
One of the first things that struck me when going through your sources is this idea that time is money. It's a phrase we hear all the time, but rarely stop to truly understand.
Yeah, that's such a great place to start. The concept of the time value of money is fundamental.
Yeah.
It essentially means that a dollar in your hand today is worth more than the promise of a dollar tomorrow. Why? Because that dollar today has the potential to grow through investment.
It's all about the power of compounding.
Right.
That's where things get really interesting.
Exactly. Let's imagine you deposit $100,000 into a savings account, just like in one of your sources,
Okay.
with simple interest. Say at 3% per year, you'd earn a fixed $3,000 annually.
Okay.
But with compound interest also at 3%, the magic happens.
Right.
Each year, the interest you earn is added to your principal, and then that larger amount earns interest the next year. Over 10 years, the difference is staggering.
So instead of just earning interest on your original deposit, you're earning interest on your interest.
Exactly.
Like a snowball effect for your money.
Precisely. And that's why understanding present and future value is crucial.
Right.
These calculations are the tools that help you determine how much an investment today will be worth down the road. Or, conversely, how much you need to invest now to reach a specific financial goal in the future. It's the foundation of smart financial planning, whether you're saving for retirement, a down payment on a house, or even just a dream vacation.
That makes so much sense. It's not just about how much you save, but also how time and interest work together to amplify your savings.
Yeah.
Speaking of investing, one of the topics you've been digging into is bonds.
Yes.
They can seem a bit mysterious, but really they're just loans packaged as tradable assets.
You got it. Think of it this way. When you buy a U.S. Treasury bond, for example, you're essentially lending money to the government.
Okay?
In return, they promise to make regular interest payments called coupon payments, and then repay the original loan amount known as the principal on a specific date.
So it's like a supercharged savings account where you're lending to the government instead of a bank.
Not quite. The key difference is that bonds can be traded in the market just like stocks. This means their prices can fluctuate based on factors like interest rates and the perceived creditworthiness of the issuer.
So unlike a savings account where your money just sits there earning a fixed rate,
Right.
with bonds, there's a chance you could lose money if you sell before maturity.
That's right. And this brings us to a crucial concept for any investor,
Okay.
market risk. If interest rates rise after you've purchased a bond, new bonds issued with higher coupon rates become more attractive to investors.
Yeah.
To compete, the price of your existing bond with its lower coupon rate will have to adjust downwards.
It's all about supply and demand.
Right,
Just
exactly.
like with any other product, if demand for something goes down, its price usually falls.
Exactly. And this interplay of interest rates and bond prices is a fundamental principle in the world of finance. It's a reminder that even seemingly safe investments like bonds come with a certain level of risk.
Right.
Speaking of risk, one of the biggest concerns for anyone lending money, whether it's a bank or an individual, is credit risk. The risk that the borrower might not be able to repay the loan.
Right. And that's where things get really interesting. We've all heard stories about people defaulting on loans or companies going bankrupt.
Absolutely.
The consequences can be pretty devastating.
Absolutely. Even the term bankruptcy itself has a fascinating origin story. It comes from the Italian phrase bancarotta, literally meaning broken bench.
Well, wow.
This harkens back to a time when moneylenders would conduct business from benches.
Wow.
If they couldn't repay their debts, their benches would be broken, symbolizing their inability to continue operating.
Wow.
It's a vivid image that captures the harsh reality of financial failure.
Wow. I never knew that. It's a powerful reminder that credit risk has been a concern for centuries.
For a long time.
So how do banks and regulators try to minimize this risk today?
They use a variety of tools. One way is to require borrowers to pledge assets like a house or a car as collateral.
Mm-hmm.
This secures the loan and gives the lender something to claim if the borrower defaults.
Right.
Then there are credit checks, which delve into a borrower's financial history, looking at their credit score, income, and debt levels to assess their ability to repay.
Right.
And of course, we have deposit insurance, like the FDIC in the US,
Yeah,
which guarantees that depositors won't lose their savings even if the bank fails.
that makes sense. It's all about layering different safeguards to protect both lenders and depositors.
Yeah.
I noticed in one of your sources that the interest rate on a savings account was significantly lower than the rate on a loan from the same bank.
Yeah.
3% versus 7.5%.
Mm.
Is this difference because of credit risk?
You've hit the nail on the head.
Okay.
Banks factor in the risk of default when setting interest rates. They need to balance the potential return with the possibility of losing money if a borrower doesn't repay.
Right.
That's why loans typically carry higher interest rates than savings accounts.
Okay.
The bank is taking on more risk when they lend money.
It's like a risk-reward trade-off. The higher the potential return, the higher the risk involved. This is definitely making me think more critically about the interest rates I see on different financial products.
That's great. Understanding this interplay of interest rates and credit risk is essential for making informed financial decisions,
Right.
whether you're saving, borrowing, or investing.
Now let's move on to a concept that often leaves people scratching their heads. Short selling. It's like the financial equivalent of betting against something right.
That's a good way to put it. Short selling is a strategy where you aim to profit from a price drop rather than a price increase. It's the reverse of the classic buy low, sell high approach.
But how can you sell something you don't even own? That's the part that always confused me.
It's a bit counterintuitive, but here's how it works. You borrow the asset, let's
Yeah.
say shares of a company stock, from someone who owns it, usually through a broker.
Okay.
Then you immediately sell those borrowed shares at the current market price.
So you're essentially betting that the price of the stock will go down.
Exactly. If your prediction is correct and the price falls, you buy back the same number of shares at the lower price, return them to the lender, and pocket the difference as your profit.
But what if the price goes up instead? Doesn't that mean you could lose a lot of money?
That's a valid concern, and it's where margin requirements come in.
Okay.
To borrow the shares for short selling, you need to put up a certain amount of cash as collateral called margin.
Right.
This margin acts as a safety net for the lender.
Okay.
If the price of the stock rises, your broker might require you to deposit more margin to cover the potential losses.
Oh, margin is like a financial buffer that protects the lender if the short seller's bet goes wrong.
Precisely. It helps mitigate the risk for the lender and ensures they're not left holding the bag if the short seller's prediction doesn't pan out. Let's look at a concrete example from one of your sources.
Perfect, because real-world examples always help me grasp these concepts better.
Absolutely. So let's say there's an investment fund called Fund ABC that believes the stock price of a company called MNQ is overvalued and ripe for a fall.
Okay.
They decide to short 500,000 shares of MNQ. Wow.
They borrow these shares from their broker, sell them at the current market price of $79.20 per share,
Okay.
and then wait for the price to drop. If their analysis is correct and the price falls, say, to $65 per share, they buy back the 500,000 shares at this lower price, return them to the broker, and keep the difference of $14.20 per share as their profit. That's a tidy profit of over $7 million.
Oh, that's a significant gain. But it's also a reminder that short selling is not for the faint of heart.
Absolutely not.
It involves a high level of risk and requires a deep understanding of the market and the company you're betting against.
You're absolutely right. Short selling is a complex strategy that's best left to experienced investors who have the knowledge and resources to manage the risks involved.
Right.
But it's an important part of the financial ecosystem, providing liquidity and potentially preventing assets from becoming overvalued.
Speaking of the financial ecosystem, we've talked a lot about banks as lenders.
But they play many different roles in the financial world, right? They're not just about savings accounts and loans.
Absolutely. And it's important to distinguish between the different types of banks. Commercial banks are what most people are familiar with.
Okay.
They handle our checking and savings accounts, offer loans and mortgages, and generally cater to individuals and businesses.
Right.
They're the banks we interact with on a daily basis. Then there are investment banks, which focus on more complex financial activities.
Oh, okay.
They help companies issue stocks and bonds, facilitate mergers and acquisitions, and trade in various financial markets.
Now, I remember coming across something called the Glass-Steagall Act in one of my sources.
Uh-huh.
Did that separate commercial and investment banking?
Yes, in the U.S., the Glass-Steagall Act of 1933 established a clear separation between these two types of banking.
Okay.
It was enacted after the Great Depression to prevent risky investment banking activities from potentially harming the stability of commercial banks and the deposits of everyday people.
So it was like a safety measure to protect the financial system from potential meltdowns.
Right. Exactly. But here's where it gets interesting.
Okay.
The Glass-Steagall Act was repealed in 1999, and there's an ongoing debate about whether this contributed to the 2008 financial crisis.
Interesting.
Some argue that the repeal allowed financial institutions to become too big to fail and engage in excessive risk-taking, blurring the lines between commercial and investment banking and ultimately contributing to the crisis.
That's a complex issue with no easy answers.
It is.
It makes you wonder about the unintended consequences of financial deregulation.
It certainly highlights the challenges of striking the right balance between promoting innovation and competition in the financial industry,
Yeah.
while also ensuring stability and protecting consumers.
And speaking of ensuring stability, what about central banks? They're like the guardians of the financial universe, right?
That's a good analogy. Central banks, like the Federal Reserve in the U.S., play a crucial role in maintaining financial stability.
Yeah.
They set the rules of the game, influence interest rates, and have a powerful impact on the overall economy. They act as the lender of last resort to banks providing liquidity during times of crisis, and they also regulate the money supply to control inflation.
So they're kind of like the referees of the financial system, making sure everyone plays by the rules and trying to prevent things from spiraling out of control.
Exactly. One of their key responsibilities is controlling inflation,
Right.
which is the rate at which prices increase over time.
Right.
Remember how we talked about the time value of money?
Yeah.
Well, inflation is the enemy of that concept because it erodes the purchasing power of your money.
Right.
If inflation is high, the same amount of money will buy you fewer goods and services in the future.
That's why it's so important to make sure your investments are growing at a rate that at least keeps pace with inflation.
Exactly.
Otherwise, you're effectively losing money over time.
Precisely. Central banks use various tools, including adjusting interest rates to try to keep inflation in check and maintain a stable economic environment.
This is really making me appreciate how interconnected everything is in the financial world.
It is.
Interest rates, inflation, central banks, it's all part of a delicate balance that affects all of us.
You're absolutely right. And speaking of interconnectedness,
Yeah.
it's important to remember that finance isn't confined by national borders.
Right.
In today's globalized world, money flows freely across countries,
Right.
and this creates both opportunities and challenges.
Right. The sources I shared hint at the increasing globalization of finance and the complexities it brings.
Absolutely.
If you wonder how regulators can effectively oversee a system that operates across so many different countries and jurisdictions.
It's definitely a challenge, and we'll delve deeper into this topic in the next part of our deep dive. We'll explore the world of international banking regulations,
Okay.
the rise of offshore financial centers, and the ongoing debate about finding the right balance between national sovereignty and the need for global financial stability.
That sounds fascinating. I'm ready to venture beyond borders and explore the global dimensions of finance.
Great. But before we cross continents, let's take a moment to recap the key concepts we've covered in this first part of our deep dive.
Sounds like a good plan.
Yeah,
It's amazing how much ground we've covered already.
it is.
We started with the fundamental concept of the time value of money, highlighting the power of compounding to grow your wealth over time.
Exactly.
We then delved into the world of bonds, exploring their characteristics as tradable loans and the risks associated with fluctuating market prices.
Yeah.
We uncovered the importance of credit risk and the measures banks and regulators take to mitigate it, from collateral and credit checks to deposit insurance.
Yes.
We even demystified the world of short selling, breaking down the steps involved and understanding the role of margin requirements in protecting lenders.
Yeah.
And we explored the different types of banks, the impact of the repeal of the Glass-Steagall Act,
Yes.
and the crucial role of central banks in maintaining financial stability and controlling inflation. It's been quite a journey so far. I feel like we've gained a solid foundation in the fundamentals of finance.
And we've only just scratched the surface. There's so much more to explore.
I'm ready to dive even deeper in the next part of our exploration.
Excellent. Welcome back to our deep dive. We've laid a great foundation, but now we're going to zoom in on this fascinating world of bonds and interest rates. It's more than just numbers. It's about understanding the forces that shape value over time.
You know, before we jumped into this deep dive, I thought bonds were pretty straightforward.
Yeah.
But now I'm seeing how much depth there is to these seemingly simple financial instruments.
That's the beauty of it. It's like peeling back the layers of an onion. Let's revisit that idea of a bond as a loan packaged as a tradable asset. Unlike a loan agreement tucked away in a drawer, a bond lives and breathes in the market, and its price can fluctuate like a stock.
So what makes the price of a bond go up or down? Is it like a popularity contest among investors?
It's more about the relationship between the bond's interest rate and the prevailing interest rates in the broader market. When you buy a bond, you're essentially locking in a specific interest rate. That's the coupon rate, the annual interest payment you'll receive. But imagine interest rates rise after you've purchased your bond. Suddenly, new bonds issued with higher coupon rates become the hot new item.
Makes sense. Everyone wants a bigger piece of the pie, so naturally investors would flock to those higher-yielding bonds.
Exactly. So to stay competitive, the price of your existing bond with its lower coupon rate has to adjust downward. Think of it like a seesaw. When interest rates rise, bond prices fall. When interest rates fall, bond prices rise.
Okay, I'm seeing the connection now. But how do we actually put a price tag on a bond? It seems like there must be a formula or some complex calculation involved.
You're right, it's not just a random number. The fundamental idea is to discount all the future cash flows you'll receive from the bond, those coupon payments, and the principal repayment at maturity back to their present value. Remember, a dollar today is worth more than a dollar tomorrow because it has the potential to grow through investment.
Right, that's the time value of money in action.
Yeah.
But how do we determine the discount rate to use?
Typically, we use the prevailing market interest rate as the discount rate. It reflects the opportunity cost of investing in this particular bond versus other available investments.
So if market interest rates are high, the discount rate will also be high, and the present value of those future cash flows will be lower, resulting in a lower bond price.
Precisely. It's all about assessing the relative attractiveness of different investment options. But here's where things get even more interesting. Remember, we talked about different interest payment frequencies?
Yeah.
A bond could pay coupons annually, semi-annually, or even more frequently.
Right. And we also touched upon the concepts of spot rates and forward rates, which represent interest rates for different time periods.
Exactly. All these factors, the discount rate, the coupon payment frequency, the time value of money, and the different types of interest rates come into play when calculating the price of a bond. It's a multidimensional puzzle that reflects the complexities of the financial world.
This is really making me realize that there's a whole science behind valuing these seemingly simple instruments.
You're right, it's not just guesswork. There are established methods and mathematical models to ensure that bond prices reflect their true value in the market. Understanding these principles can give you a real edge as an investor, helping you make more informed decisions about which bonds to buy or sell.
Okay, so we've talked about how bond prices and interest rates are interconnected. But what about this thing called the yield curve? What exactly is it, and how does it fit into all of this?
The yield curve is a powerful tool that provides a visual snapshot of interest rates for bonds with different maturities, but with the same credit quality. Typically, we look at the yield curve for U.S. Treasury bonds because they're considered essentially risk-free, backed by the full faith and credit of the U.S. government.
So it's basically a graph that shows how interest rates vary based on the time horizon of the investment.
Exactly. Now, a normal yield curve typically slopes upwards, meaning that longer-term bonds have higher interest rates than shorter-term bonds. Think about it. Lenders demand a higher return for tying up their money for a longer period. They face more uncertainty and potential risks over a longer time horizon, so they want to be compensated for that.
Makes sense. It's like a premium for patience and the willingness to take on that added risk.
Exactly. But here's where it gets fascinating. Sometimes the yield curve can invert, meaning shorter-term interest rates become higher than longer-term rates. This inversion is often seen as a warning sign of an impending economic slowdown.
Hold on. Why would investors accept a lower return for a longer-term investment? That seems counterintuitive.
It signals that investors are expecting economic conditions to worsen in the future, leading to lower interest rates down the road. They're essentially betting that the central bank might lower interest rates to try to stimulate the economy. So they're willing to lock in those lower long-term rates now, even if it means sacrificing some potential return in the short term.
Wow, so the yield curve isn't just about interest rates. It's like a window into the future of the economy.
You're catching on. The shape of the yield curve, whether it's normal, inverted, or flat, can provide valuable clues about investor sentiment and economic expectations. It's a tool that economists and policymakers watch very closely.
It's like a financial crystal ball revealing insights into the economy's future path. Who knew that a simple graph could hold so much information?
That's the power of financial analysis. It's about connecting the dots, understanding relationships, and using data to make informed predictions.
This is really eye-opening. I never realized how much depth and complexity there is to bonds and interest rates.
And we've only just scratched the surface. There's a whole world of advanced concepts related to bond yields, credit risk, and even more exotic financial instruments like derivatives.
Bring on the challenge. I'm ready to delve deeper into these fascinating areas of finance.
Excellent. In the final part of our deep dive, we'll explore some of these more advanced concepts, connecting them back to the fundamentals we've covered today. Get ready for some mind-bending insights that will take your financial knowledge to the next level.
Welcome back to the final chapter of our financial deep dive. It feels like we've been on a whirlwind tour of bonds and banks and the forces that drive the global economy.
It's certainly been an illuminating journey. And in this last segment, we're going to explore some more advanced bond concepts and then venture into the intriguing world of derivatives.
I'm all ears. You mentioned something called implied yield to maturity in the last part. Sounds pretty complex.
It might sound intimidating, but the concept is actually quite practical. When you buy a bond at its face value, the yield you earn is simply the coupon rate, those periodic interest payments. But remember, bond prices fluctuate in the market.
Right.
So if you buy a bond at a discount, meaning below its face value, you'd naturally expect a higher return, right?
That makes sense. You're getting the same future cash flows, those coupon payments and the principal repayment, but you paid less up front. So your overall return should be higher.
Exactly. That's where the implied yield to maturity, or YTM for short, comes in.
Okay.
It represents the total return you can expect to earn if you hold the bond until maturity, taking into account the purchase price, those coupon payments, and the principal repayment.
So it's like calculating the effective interest rate I'm getting on the bond, considering I might have bought it at a bargain price or even at a premium.
You've nailed it. YTM factors in the time value of money and all the cash flows associated with the bond to provide a more accurate measure of your potential return. As you mentioned, buying a bond at a discount generally results in a higher YTM compared to buying it at face value.
Okay, I'm starting to grasp the idea, but how do we actually calculate this YTM? Is it a complicated formula?
It can involve some math, especially when you consider different coupon frequencies and compounding periods. Thankfully, in today's world, we have spreadsheets and financial calculators to do the heavy lifting for us.
Technology to the rescue. So what are the key takeaways for an everyday investor like me? Why should I care about YTM?
Understanding YTM is essential when comparing different bonds and making informed investment decisions.
Okay.
A bond with a higher YTM might seem more attractive on the surface,
Right.
but remember, it's crucial to consider other factors like credit risk and the time horizon of your investment.
Right. We talked about credit risk earlier. A higher YTM could indicate that the bond issuer is considered riskier and investors are demanding a higher return to compensate for that risk.
Exactly. Higher potential returns often come with higher risks. It's a fundamental principle in finance, and it applies to bonds just as much as it does to stocks or any other investment. Let's revisit the concept of credit risk by comparing bonds issued by corporations to those issued by the U.S. Treasury.
Okay, we touched on this earlier, but I'm still a bit fuzzy on why a corporate bond would typically have a higher yield than a treasury bond with the same maturity.
It boils down to the perceived creditworthiness of the issuer. U.S. Treasury bonds are considered virtually risk-free because they're backed by the full faith and credit of the U.S. government.
Right.
It's highly unlikely that the U.S. government will default on its debt.
Right. The U.S. government has a long history of paying its debts, and it has the power to tax its citizens to raise revenue. That makes treasury bonds a pretty safe bet.
Exactly. But corporations, even large and well-established ones, face various risks that could affect their ability to repay their debt. Their financial performance might fluctuate. They could face increased competition, or unexpected events like natural disasters or economic downturns could impact their business.
So investors demand a higher yield on corporate bonds to compensate for that added risk of potential default.
Yes,
It's like a risk premium built into the interest rate.
precisely. It's similar to how insurance premiums work. You pay more for insurance if you're considered a higher risk. With corporate bonds, that higher yield is the insurance premium investors demand for taking on the risk that the company might not be able to make all its interest payments or repay the principal when the bond matures.
That's a great analogy. It helps me understand the logic behind those yield differences.
Yeah.
Now, I remember one of the sources mentioned zero coupon bonds. What are those and how do they fit into this whole picture?
Zero coupon bonds are an interesting breed. They're a type of bond that doesn't make any regular interest payments. no coupons.
Mhm.
Instead, they're sold at a significant discount to their face value,
Okay.
and the investor receives the full face value at maturity.
So your entire return comes from the difference between the discounted purchase price and the face value you receive at maturity.
Exactly. It's like buying a bond on sale and waiting for it to mature to its full value over time. The difference between the purchase price and the face value represents the interest you earn over the life of the bond.
That's an interesting concept. But it seems like zero-coupon bonds would carry a significant amount of credit risk. Since there are no regular interest payments, you're really banking on the issuer's ability to stay afloat until maturity and make that one lump sum payment.
You're absolutely right. Zero coupon bonds can be riskier than traditional bonds because you're essentially putting all your eggs in one basket, hoping that the basket won't break.
Right.
If the issuer defaults, you could lose a substantial portion, if not all of your investment.
It's a high-risk, high-reward scenario. You have the potential for higher returns because you're buying at a discount, but you're also taking on more risk if the issuer's financial health deteriorates.
Precisely. It highlights the importance of carefully assessing credit risk and the issuer's financial stability before investing in any bond, especially zero coupon bonds.
Okay, we've covered a lot of ground on bonds, from the basics to some more advanced concepts. But I'm curious, are there other financial instruments or strategies that connect to what we've been discussing?
Absolutely. The world of finance is vast and interconnected. One area that often captures people's imagination is the realm of derivatives.
Derivatives, that sounds mysterious and intriguing. What are they exactly?
Derivatives are financial contracts whose value is derived from an underlying asset. Think of it this way: their value is linked to or depends on the performance of something else. That underlying asset could be a stock, a bond, a commodity like gold or oil, or even an index like the S&P 500.
So they're like financial tools that allow you to leverage or manage the risks associated with other assets.
That's a great way to put it. Derivatives are used for various purposes, including hedging against risk, speculating on price movements, or gaining specific market exposures.
So someone could use derivatives to protect themselves from potential losses in their investments,
Yes.
or to make a bet on whether a particular asset will go up or down in value.
Exactly. One common type of derivative is a futures contract. It's an agreement to buy or sell an underlying asset at a predetermined price and date in the future.
So it's like locking in a price today for a transaction that will happen later. I could see how that could be useful for businesses that want to protect themselves from price fluctuations.
You're right. Futures contracts are often used by businesses to hedge against price volatility in commodities they need for their operations. For example, an airline might use futures contracts to lock in the price of jet fuel to protect themselves from unexpected price increases that could hurt their profitability.
That makes perfect sense.
Yeah.
So derivatives can be used to mitigate risk, but they can also be used for speculation, right?
Absolutely. Some traders use derivatives to bet on the direction of price movements in underlying assets. If their predictions are correct, they can potentially make significant profits. But if they're wrong, the losses can be substantial.
It sounds like a high-stakes game. It seems like derivatives can be powerful tools, but they also come with a high level of risk.
That's why it's crucial to have a deep understanding of these instruments and the underlying markets before venturing into the world of derivatives. They're not suitable for everyone, and they require careful risk management and a solid understanding of the potential downsides.
That's a valuable piece of advice. This deep dive has truly broadened my understanding of finance. We've explored the foundations of bonds and interest rates, delved into the intricacies of credit risk and yield to maturity, and even touched on the complex world of derivatives.
It's been a pleasure guiding you through this exploration. And remember, the world of finance is dynamic and ever-evolving. There's always more to learn, new innovations to explore, and fresh challenges to navigate.
I'm definitely feeling more empowered and informed as I continue my financial journey. This deep dive has given me a solid framework and a set of tools to analyze financial information and make more informed decisions.
And that's what it's all about. By understanding the fundamental principles and the interconnected nature of the financial world, you're equipped to make choices that align with your goals and values.
So there you have it, a deep dive into the world of finance. We've uncovered the inner workings of bonds, banks, and the forces that shape our financial lives. But as we wrap up, I'm left with one final thought.
I'm intrigued. What's on your mind?
If you had the power to redesign the financial system, what would you change to make it more stable, transparent, and beneficial for everyone? It's a question worth pondering as we navigate the complexities of the financial world.
That's a brilliant question. It challenges us to think critically about the current system, to identify its strengths and weaknesses, and to envision a future where finance serves the best interests of individuals, businesses, and society as a whole. Keep asking those tough questions, and you never know, you might just contribute to shaping a better financial future for all a lot.